The Fed has finally announced long-awaited quantitative easing, QE3, and markets are giddy on this news. Joining me to break down what this means for the bond market in particular and the economy, we've got Steve Rodosky, the head of U.S. government bond trading at money manager Pimco. Steve, thanks for joining me, and really was wondering, even though this move was expected, why do you think investors are so excited, particularly equity investors, about this news? What really might this mean for the broader U.S. economy?
Well, I think the probability going into it, it was less than certain for sure, so you're going to get the immediate thrust and the reaction. And I think a balance sheet expansion, the way they announced through their MBS purchases, being mindful of the fact that before this operation there was zero net production of mortgage-backed securities by month, that they're going to actually be depleting the stock through this effort. That's given a certain a lift to a lot of the risk markets today as a knee-jerk reaction.
Right. Since this is really targeted at mortgage-backed securities, I think people are hopeful that this might do more to build on what seems to be a nascent housing recovery. Are you optimistic that maybe that might be true, that this could be a good sign for the housing market?
It's helpful, no doubt, because it's more direct than what they've been doing for the last several months. But I still think that what is required is to have both engines in Washington humming. And in the absence of an active fiscal body, I'm not so sure that it will carry us to the finish line, as it were, all the way to a complete and sustainable economic recovery.
Right. How concerned are you that despite the Fed's best efforts to rejuvenate the economy, that this could all be for naught if Congress messes it up?
Well, it's certainly a risk, and if you just go back to last August after the downgrade and you saw the reaction from the stock market and the like, the paralysis in Washington is certainly a real and credible threat to the recovery. So it's of utmost concern to most investors right now.
Are you worried at all that with rates as low as they are, even though they're a little bit off the historical lows, that bonds might be just this great big bubble waiting to pop?
I'm less worried than others may be. I think typically for bubble conditions, I think you really need a less actively traded market.
Do you think China and Japan and other large U.S. creditors will view this favorably, or is this maybe one of the last straws for many investors that are probably dissatisfied with the low rates that U.S. Treasuries are giving them right now?
There's still not a lot of alternatives out there. A lot of times we call it the U.S. market being the cleanest dirty shirt.
Right.
So I'm not so sure that you'll see an exit or a real-time disappointment and reaction from it. But again, there's certainly risks on the horizon as whenever the foreign ownership gets to the levels that it has. That it's something to be mindful of, but probably over a secular horizon rather than in the immediate future.